Economic value which you are using for a short term period. All the assets which can be converted into cash within 1 year. At the time of purchase and sale, they are not going to demand for money immediately. They give permission or they give some time to pay the money. So he became the debtor. All the business, they maintain the accounts in order to know whether you earn the profit or loss. So it should aggregate the results. You are in the position of profit or loss. Hello everyone, I am Meghna from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. We are in the session 2 of Unit 1, subject Accountancy. In the last class, we have discussed about the meaning, objective of accounting. In today's session, we are going to learn accounting terms. All the basic accounting terms which we have used in the accounting. Let us start. Accounting is the systematic record of the financial transaction of a business. Accounting is a systematic record of the transaction of a business. The recording process includes setting up a systematic record keeping, tracking transaction within that system and aggregate the results information into a set of financial reports. That means in the last class we have discussed what is the meaning of accounting. In the meaning, accounting is a process of recording all the business transaction and tracking the information. That means after recording all the transaction, whenever you want the information, it should be in a way you can easily identify. You can easily identify the transaction whenever you want. So, it should track the transaction. So, if you maintain the transaction in a systematic way, it is easy to track the information and aggregate the results. All the business, they maintain the accounts in order to know whether you earn the profit or loss. So, it should aggregate the results. You are in the position of profit or loss. So, accounting is a process of recording all the business transaction to know the profit or loss. First term is asset. An asset is a resource that has some economic value to a company and can be used in a current or future period to generate revenue. That means asset is anything which have economic value, anything which add value to your business is called assets. Either you can use for the current year or short term period, or you can use for the long term period in order to generate revenue, in order to make profit, or in order to generate revenue. You are using such assets or such thing, that is called assets. Assets means anything which add value to your business, anything which have economic value you are using for the current or the future period in order to generate the profit is called assets. Assets are reported on the company balance sheet and bought or created to increase firm's value or benefits the firm's operation. That means assets are reported on the company balance sheet. All the assets you are going to represent in your balance sheet. It shows that it add value to your business. It create to increase the firm's value. That means the more assets you have, the more value the business have. So, it helps in increasing the value of the business. Assets can be grouped into two major classes. Asset can be grouped into two major classes. First one, tangible assets and intangible assets. Tangible assets are literally anything that can be touched. Tangible means which can be touched. Tangible asset contain various subclasses including current assets and fixed assets. Tangible means which we can touch and see. So, it can be further classified into two classes, subclasses, that is first one current assets and fixed assets. Under assets you have two classes, tangible and intangible. Under tangible you have two subclasses, one current and fixed assets. What is current asset? Current assets are short-term economic resources that are expected to be converted into cash within 1 year. Current asset includes cash and cash equivalents, accounts receivable, inventories and various prepaid expenses. That means current assets are economic value which you are using for a short term period. All the assets which can be converted into cash within 1 year. In a short term period, you are getting a revenue or benefit from the asset. That is called current assets. Short term assets, short term economic value. Short term economic value or economic resources, that is considered as current assets. Current assets are cash, cash equivalents, accounts receivable, inventory and various prepaid expenses. Cash equivalent is a liquid cash easily convertible into cash. Then accounts receivable, you are going to receive in the future. When you made up sales, you have some accounts receivable. So you are going to receive in future. The amount you are going to receive in near future, that is account receivable. Inventory, the stock you are maintaining in order to sell and make a profit. So inventories, in short term only you are going to make a transaction. You are going to sell the inventory stocks and earn profit. Then various prepaid expenses. Like any prepaid expenses is a short term benefits or short term assets, all comes under current assets. Next, fixed assets. Fixed assets are long term resources such as plant, equipment and building, also referred to as PEE. That means property, plant and equipment. These are purchased for continued and long term use to earn profit in a business. Fixed assets are a long term assets. That means you are going to get benefit from those assets in future. Now you are not going to get any benefits. That means you are going to receive benefit in future, long term benefits. So property, land and building, all this is a long term assets. At the time of purchase, you are going to spend money. It became expense for you. But in future, you are going to receive the benefits. The benefit is for longer period. Continuously, you are going to use the assets. Continuously, you will get the benefit from the long term assets. So fixed assets are a long term economic resources. This group includes land and building, machinery, furniture, tools, IT equipments, example laptops. All this is an example of fixed assets. Land and building, at the time of purchase, it's a more expense. You're going to spend more money for fixed assets rather than current assets. But you get the benefit for a longer period. The fixed assets is long-term asset. It's a long-term benefits. So, land and building, machinery and furniture, you are going to get the benefit for a longer period. They are written off against the profit over their anticipated life by charging the depreciation expenses. That means these fixed assets will charge depreciation based on their life of the asset. So, based on the profit, anticipated life by charging the depreciation. So, you are going to charge depreciation on the fixed assets over profits. So, this all about fixed assets. Next, intangible assets. Intangible assets are economic resources that have no physical presence. They include patent, trademark, copyright and goodwill. That means tangible means which we can touch. Intangible means intangible assets are economic resources which have no presence. We cannot see that assets. They include patent, trademark, copyright and goodwill. Goodwill means goodwill is a good name, reputation of the company. Intangible assets includes patent, trademark, copyright and goodwill. Patent means it's a legal right. It's a legal right over something. So, you have a legal right over something. Next, trademark. Trademark means a symbol, word, registered or legally you can use to represent your company or product. You are going to register a symbol or word to represent your company or the product. Copyright means you get a legal right for a particular period. So, patent, copyright and trademark are you are getting a legal right for a particular time and you are going to register some word or symbol to represent your company or your product. Goodwill is a reputation or good name of your product. For example, again you have a term called goodwill in accounting. Goodwill means good name and reputation of your company. It add value to your business. For example, Nike shoes, normal shoes, local shoe, local and Nike shoes. You have a two types of shoe. For the local shoe, cost is 500. For the Nike, 3000. The same product with same color, quality, features, but the local product is cost rupees 500, but the branded or the Nike company shoe is for 3000. So, the customer are ready to pay 3000 for the branded goods, but not for the local product. Why? Because the name, good name, brand name for the product. So, the value for the product is 500. Remaining price is for the brand name or the goodwill of the company. So, goodwill, it adds value for your business. But they are not ready to pay more than 500. Why? Because it's local, not branded. So, the brand name or the goodwill, it add value for your business. This is all about intangible assets. Next, debtors. A debtor is a company or individual who owes money. The term debtor refers to individual as well as other firm, bank, lending companies or more. If anyone owes payment for the goods or services given to an entity or a company, the person owing may be called debtor. In a simple word, debtor means the person who is an obligation to pay or to repay the money. That means the person who has an obligation to repay the money is called debtors. For example, XYZ is a company. They manufacture a product, the manufacture of furniture. They are the manufacturer of furniture. Mr. Harish is a customer who purchased furniture from the XYZ company. He purchased from XYZ company for rupees 10,000. Rupees 10,000 he made a purchase from XYZ company. At the time of purchase, Harish is not going to pay the money to XYZ company. He takes some time that I'm going to pay you in 3 months. So, he take 3 months time to pay the money. So, Harish has an obligation to pay the money. So, he is called as debtor. He became debtor now. XYZ is the lender or giver of money. XYZ is the lender or giver of money. Harish became debtor. While preparing a financial statement of XYZ company, they treat Mr. Harish as a debtor. Debtor is an asset. Why? Because At the time of purchase, Harish is not going to pay any money. He is going to pay in later. He is going to pay in future. So, XYZ company will receive the money after 3 months. So, after 3 months, he received the money. He is receiving the money in future means it is an income for the company. So, it considered as an asset. So, in the financial statement of XYZ company, they treat Mr. Harish as a debtor and shown in the asset side. So, all the debtors are considered as assets and it represents in the asset side of the balance sheet. So, debtors, if the company has a debtors means it add value to the business. That means they have the right to receive from somebody. So, debtor means owes. Owes means obligation. Who owes the money? Who takes the money or who has the obligation to pay the money? So, here Harish owes money from XYZ company. Harish owes money from XYZ company. XYZ company is a lending company or firm. So, here he is treated as an asset for the XYZ company. Debtor means who has the obligation to repay the money. Next, creditors. A creditor is an entity, person or institution that extends credit by giving another entity permission to borrow money intended to be repaid in the future. A business that provides supply or services to a company or individual and does not demand payment immediately is also considered as creditor. In the last example, XYZ and Mr. Harish became the debtor. XYZ company became creditor. That means he is giving the money or money's worth to the Harish. So, he is giving permission to pay money in future. It says a business that provides supplier or services to the company or individual does not demand payment immediately. Now, he is not going to demand for money and that permission to borrow money. They gave permission to borrow money. So, he is considered as a debtor. That means one entity, he gave permission to another entity or individual who gave permission to another entity to give money. So, here they giving another entity permission to borrow money intended to be repaid in future. So, he is going to pay in future. They will not demand for immediately. And again, in business, at the time of purchase and sale, they are not going to demand for money immediately. They give permission or they give some time to pay the money. So, he became the debtor who gave permission to repay the money in future. He became the debtor. The person who takes the permission or who take money from the business became creditor. The concept of debtor and creditor is interrelated. ABC and XYZ. ABC is the company, XYZ is a financial institution. ABC is a company and XYZ is a financial institution. They need 10 lakh rupees for their business. So, they approach XYZ financial institution to borrow the money. XYZ company, they give 10 lakh rupees for ABC company and they give some time to repay money. Here ABC owes money. That means ABC company have obligation to repay money for the XYZ financial institution. Here XYZ They give money, they give permission. Here one entity, they give permission to borrow money intended to be repaid in future. He give permission for the ABC company to repay in future. Now XYZ company became the creditor and ABC became the debtor. Now in ABC Company Limited, when they are preparing the financial statement, in their book, they consider XYZ as a creditor. Here he became the creditor. So they consider as a creditor. Here in this case, they have a obligation to repay money. They have a ABC company has liability to pay money. So it is considered as liability. It's considered as liability. So in the balance sheet, this creditor is considered as liability. That means you have an obligation to repay in future. You will write in the credit side or in the liability side of the balance sheet. So creditor is a person who give permission to borrow money to repay in future, or individual or the firm does not demand for the payment immediately. He became the creditors. This all about asset. Under asset only you have a tangible and intangible. Under tangible, current and fixed assets, and intangible, goodwill, patent and copyright. Next, debtors and creditors. So we finished only asset, under asset, tangible asset, intangible asset. Here you have under tangible, current assets and fixed assets, intangible, goodwill, patent, trademark, copyright. Next, this is first. Again, debtors and creditors. In today's session, we just learn 3 terms. Under the assets, we have subclasses. This is all about today's session. In the next session, just continue with the other terms. Let's meet in the next session. Until then, keep watching. Thank you.